I quit my job as a market maker in June of 2002, and the market was changing so much at that time. It was definitely becoming harder to make money, and so I was ready for a change. I was ready to do something different.
Mm.
Um, when I left, there were 10 traders on my desk and probably another 30 on our over the counter desk. And when I went back 7 or 8 years later, and I'll get to this, but when I was working in fintech and I went back, visited my old trading desk, there were three people and a really large computer.
Welcome to the Market Call Show, where we discuss investing wisely and living well. Tune in every Thursday to Apple Podcasts, Spotify, Google Play, or subscribe on YouTube.
Jason Meshnick, how are you?
I'm doing great, Lewis. It's so great to see you.
I know. I'm so glad to finally have you on the podcast. Just knowing you for so many years and, knowing that you have so much knowledge out there with regard to investing and just your overall creativity, I had to have you on, and I'm so glad that you came on
Well,
today.
and one thing, as you know from our relationship, I've always gotten so much out of talking to you, and I always learn something just through our conversations. And I feel like by the time this podcast is over, I will have 5 new ideas to go after and try to figure out what to do, how to make them all reality. So
Oh God, I hope so. I hope so. It's all about the ideas.
exactly.
It was funny. I asked you to send me your bio. I've known you for a long time, and we met years and years ago at a CFA meeting. I think we were both on a board for the CFA Colorado or Denver chapter, and since then we've worked together in many capacities. But I didn't know a lot of things about you that I should have known just reading your bio. I knew that you spent 20 years in the fintech world. And I didn't know that you were also working on some AI investment analysis, which I'd like to learn more about, and that you really have a lot of passion for educating. And I guess your coworkers asked you to write a newsletter. Had no idea about that. And now what is this about vampires are rich? Why are vampires so rich?
That was one of
Uh,
my favorite things that I wrote. Yeah. If you want to cover that now, we can, or we can talk later.
we can talk. I
Um,
think we'll come circle back to that, but I was I was like,
okay.
what's that about? But yeah, and now you're doing some teaching at CU Boulder, teaching finance. We've done a little bit of lecturing together at the university level, DU, and things like that. And I've always enjoyed watching you teach because you seem to captivate the kids. Well, they're not kids, the young adults, with your style. So I'd like to learn a little bit more about what you're doing there. And you are a Wall Street trader and market maker, and there's a lot of things that you know about microstructure and investor psychology that I want to kind of touch on too. So, but the big thing is understanding that you were involved with the CNN, that popular fear and greed index back in 2012. I guess that was put together. So I don't know. Maybe what we could do is talk a little bit about your background. I mean, I kind of covered it a little bit, but just maybe you can tell me a little bit about, share with the audience how you got in this business and kind of what's been your progression in this business.
Yeah. So um, my guess is that everybody says this, but I came to it from a slightly different path. Not that, not that, I didn't get out of college and immediately go to Wall Street. That's a pretty normal path, right? But I was a philosophy major, and I'm far from a philosopher. But I think what I took away from my undergrad as a philosophy major was just sort of a way of thinking, right? As opposed to being sort of a business person thinking only about money. It's more about thinking about other kinds of things and things that drive people, and being able to draw from communication and trying to understand what people think, and how they think and why they think. And I think it was one of the things that really fascinated me. Also, being a child of the '80s,
Hmm.
Wall Street was so important. There were so many movies about it, right? From the Wall Street movie to, I don't know, it seemed like every other movie that came out was about how to make millions of dollars on Wall Street. And so, of course, I wanted to be part of that. Having grown up in sort of a backwater Poughkeepsie, New York, I always wanted to go live in the big city. So, um, yeah, so that was sort of my start, was coming at it from kind of a weird direction, right? And I ended up immediately going to work for, well, a firm that no longer exists, for a couple of reasons, but it was the trading arm of a New York specialist firm. So the specialists were downstairs on the floor of the New York Stock Exchange, and my boss was one of their customers, and he just worked upstairs in their clearing division, and he was trading his own money. He had been a floor broker for 20 years, owned two seats, sold his seats, did pretty well on them, and then decided that he was just going to live the rest of his life as a trader.
Mm.
Brought his son in, and then eventually I was working as a runner, so making $14,000 a year, and just wanted exposure, just wanted to be part of the action. Right, I love the
Nice.
action. I was so excited about just being there. The history, I love the history of things.
Mm.
I probably should have been a history major, and so just being in that environment, I ended up getting picked up because I was pretty cheap, right? So they didn't have to pay me much, and I ended up working and really, falling in love with being a trader and learning about how the market worked and how floor brokers could help make these trades. We had a network of 20 floor brokers across the New York Stock Exchange and what was then called the Amex and some of the regional exchanges too, so that we could trade, and we'd strategize every morning and then make our buy and sell decisions, and then throughout the day update them as needed. I like to say that we were the high frequency traders of the time,
Mm.
even though our frequency wasn't that fast, but we were sitting on both sides of the bid and the offer.
Mm. Boy, times have changed, huh?
Um,
From
yeah, I mean
there.
yeah. I like to say when I started in the business, there were people there who'd been on the floor in 1929, and so much of the floor of the New York Stock Exchange looked the same as it did in 19. If you were to go take Jesse Livermore and drop him, from 1929, and just drop him on the floor in 1992 when I started, he'd have been like, oh, I don't know what these TV things are that are all around. He wouldn't have even had that word.
Mm.
But otherwise, he'd have been able to run into a crowd and know exactly what to do. And by the time I left in 2002, well, there wasn't even a crowd, right? I mean, everything was different about the floor of the exchange. I was a market maker on a fully electronic stock exchange. So the principles were all the same, but everything else had changed. It was so different.
Oh, that's a big part of what I wanted to talk to you about, that the principles are all the same. So, because I was just listening back to some of our, or looking back at some of our conversations just to prepare for this. And we've had a lot of conversations in the past where you were really outlining, like, I want to capture what I saw, those principles that I saw on the floor, and I want to capture them today. And that's kind of driven a lot of things that you've done. So maybe you can tell me, like, just a handful of what those principles are that you've noticed are like still the same now, that probably will never change.
Well, so I'll caveat this by saying I've been out of the markets for a number of years.
Okay.
Right. So I left trading in 2002, and then I was still, kind of a pretty active um, trader investor for the next 10 years or so. But then, life gets in the way, and I'm just very busy. And so I've sort of shifted my focus in a number of ways. And I'm honestly really interested in analysis now, and thinking about, market sentiment and what investors are doing and how investors think about the market. And I now, when I trade, it's opportunistically, right? I'm not in
Mm.
there every day. I'm not trying to make eighths or
Right.
even pennies.
Yeah, I
It's
guess we
now
should
more about,
probably.
yeah.
Oh, I'm sorry to interrupt you there. I
No,
was
go
just
go ahead.
I was just gonna say, I guess we should probably back up a little bit and talk a little bit about, like, more about your career progression, because you
Sure.
moved into from trading into fintech, and from fintech now to working at the street.com and as an editor. So, and which to me makes 100% sense. Just from what I know from your talent, your talent stack. So maybe you can kind of
Yeah.
finish that progression a little bit. So to where you are now.
Yeah. Sorry. Yeah.
No,
Totally.
no.
So my progression is really. I mean, there's a couple things that run through the entire thing, and I think a big part of it is analysis and being excited about thinking about the markets, right? About being in some ways just part of the culture of it, right? But so that's been the big thing that's run through my entire career. But in 2002, my wife and I, we weren't married at the time. We were thinking about, where will we end up? And we decided that we'd either end up in New Jersey or we could move somewhere that we wanted to live. So we did a search all around the country and decided we just sort of threw a dart at the wall and said Colorado seems pretty nice. So we ended up here in Colorado, and it's been the best move.
Man, that was a
Right?
lucky dart throw, if you ask me.
It's a
That's
lucky dart throw.
yeah,
I think
that's a
it
pretty
was
nice.
guided by my wife's hand. She may have said, "I'll take that dart, and I'm going to place it right here,
Oh, I see. Okay.
just at the foot of the Rocky Mountains." So she'd been out here
That's cool.
and visited and said, "Boulder is going to be the place where Jason will be happy, and we'll make this happen." Um, and so we moved out here without jobs. I quit my job as a market maker in June of 2002, and the market was changing so much at that time. It was definitely becoming harder to make money, and so I was ready for a change. I was ready to do something different.
Mm.
When I left, there were 10 traders on my desk and probably another 30 on our over the counter desk. And when I went back 7 or 8 years later, and I'll get to this, but when I was working in Fintech and I went back, visited my old trading desk, there were 3 people and a really large computer. And rather than taking directional bets on the market, they were doing arbitrage, and they were working the order flow, and they were figuring out based on the order flow how long or short they were going to be, sort of using quantitative methods to understand if they felt the market was going up and they were going to end up being more short and more short, they would have to think about the delta to the market and try to get long ahead of those people so they could be selling to them. So it became in some ways, probably much more intellectually engaging thing than just sitting saying, "Oh, someone just sold me 1,000 shares. I have to get out of it now." You were thinking ahead of the market in many ways. It was really cool. I probably would have liked it a lot, but it just became a really different animal, right? It was much more arbitrage as opposed to directional trading, which is really what I knew. So we moved to Colorado without jobs, and in doing that, that's when I met you, Lewis. I was pretty engaged with the CFA Society, despite not having a CFA. I'll throw that out there. I'd also just finished my MBA at NYU,
That counts.
so I think they let me in, but that was about it. And they let me even onto the board. Yeah. So
yeah, you're a very likable guy, so it was pretty easy decision. They're like, he doesn't have a CFA, but he's pretty cool guy. We'll let him in anyway. So
I think they also said this is a guy that we can make do all the programming. We can make him call all the people that we don't want to call and try to organize meetings. And they thought I was an event planner, which it turns out I'm not. I'm just not a good event planner. My wife can tell you that. Actually, Lewis, you did kind of the same when we were organizing all the CFG meetings.
Yeah.
It's like, yeah, let's go call some people. Yeah, but so it took a while, and I ended up finding this job here in Boulder for a company called Wall Street On Demand. And for those who are not familiar with Wall Street On Demand, it has a new name. It became it became Wall Street On Demand. Then it became Market On Demand once Market bought us, and then eventually it became Market Digital when they decided that it was really time to think more broadly than just web and think broadly across all digital formats, video, et cetera, and advertising. And I stayed there for 19 years, where, Lewis, you touched on the AI side of what I did. And so this is one of my big jokes, is that I like to say that was the world's most widely read analyst, if not the best. And the reason why I say that is because over the 19 years that I was at that company, I built something like, I don't know, 200 different, I call them only because of today's terminology and the way that people talk about markets now, or sorry, not about technology now, I call these AI related, and they really are simple. They're very much rules-based AI. So sort of traditional AI, not these large language models that we have now, that are in some ways more sophisticated, but really not as good. So what I was building were these big decision trees. And these decision trees were things where you would, using your financial knowledge, you would say, okay, I'm looking at some financial data around a company. What do we need to know? Well, let's start with the valuation. Is the stock, what's the PE ratio? Is it a high PE ratio or a low PE ratio? How do you define a high PE ratio? Is a high PE compared to its average for the last 5 years? Or is it is it the highest in its industry, right? You can look at things cross-sectionally or historically, right? But both ways, time-based or versus peers. And so we would do things like that, and we would chop up the market and try to understand, which stocks were good or bad, but it wasn't necessarily for an investment perspective, right? This was because what we were doing was for the Schwabs and TD Ameritrades and all those companies. We were building the news and research portions of their website. And so I and my team were providing that research. And so a lot of the text that you would see on that site was completely dynamically generated. So very, simple rules-based AI. And I say it's better than large language models for AI because large language models, you never really know what you're going to get. It's a bit of a black box, right? So what we could do is I would create text that was locked down. I knew exactly what it was going to say. I didn't know what the data was that was going into it, right? I didn't know if Apple had a high PE ratio or a low PE ratio, but I had rules around defining what was high and low. And so when I would go to the compliance departments at Schwab or at TD Ameritrade or Fidelity, et cetera, we worked with all the US brokers, many of the Canadian brokers, Australia, others. I would go to the compliance departments and they would say, well, how do I know that you're not going to say something silly or that's incorrect? And I said, well, I'm going to give you the entire decision tree and you're going to be able to look at the decision tree and understand what it says. So the only way that my model can be wrong is if I have a bug, and there are bugs all over the internet. So I'm as fallible as anybody else, but we're going to do our best not to have those. And then secondly, if the data is wrong. And if the data is wrong, well, it's wrong all over the website too. And, we're going to fix that. But generally, 99.9% of the time, for 99.9% of the stocks, what we say is going to be accurate. It's going to be correct. It is going to be as unbiased as possible because I'm not trying to tell you as a value investor or a growth investor or whatever what you should do. I'm just trying to describe the various aspects of the stock. I wasn't there to give you a buy, sell, hold recommendation. I was purely there to help you as a self-directed investor understand more about the stock, about the company.
You brought up something that's really interesting about that. I mean, I have to, you're talking about large language models and it's a little bit of a black box. We don't really quite know. And you're dealing with these big decision trees, or you were at that time, and it was traceable. Like you could trace the logic. So, which made me think, okay, we have data, and the data can be right or wrong. And then you have the logic, and the logic can be right or wrong. And I think that's one of the things that I always have having a little bit of an issue with some of the AI is the logic element of it, because like how much of it is curve fitting, what is real behind it. So we could use it. I had a tech executive tell me one time that the big thing with AI is it can help us with speed and it can help us with accuracy if we use it correctly. But it's not necessarily like you still need human thought. You still need that ultimate human element to it. That's my personal opinion on that. But the fact that you were using decision trees early on, and just to get information, that way you were speeding the process for the investor. Basically,
right?
It's like they would spend a lot of time looking for all those things, but you systematically sped it up, which is a big thing for. And we all have that now. There's just like different flavors of it. So it's a whole nother topic we can get into a little bit later. But I remember you talking about that when you were working on those projects, wondering where it would go next. As far as that goes. But getting back to your story, let's get back to your story now. I just had to interject.
Sorry, we keep getting off track.
Yeah, that's okay.
So while I was at that job, I did a number of things. I mean, it was really an exciting job in so many ways. But the two big things that I did were really this, running the natural language generation product, right? This thing, we called it smart text. And so that's that AI thing. But then the other thing that I was so excited about was doing education, right? So this started back in 2006 or 7. I started doing brown bag lunches where I would just put together a presentation and teach our developers and designers and and engineers all about everything they needed to know about investing, not so that they could go out and make $1 million, but rather so that when they were building the tools that we were all using, they understood their subject matter, right? That they could be engaged with the topic and identify with the end user and really understand why a PE ratio mattered or why a chart mattered. Simple thing like in design, you'll notice that there's a lot of white space on many pages, and they talk about that as being good design. It's actually really bad design for investors. And the reason is, well, depending on the type of investors, but for slightly more active investors, engaged investors, what they want is information dense things. And so I would help steer our design team to create things that were a little bit more information dense. An example being a chart, a price chart. You don't want to have to scroll up and down too much to be able to read your price chart on your Schwab account, right? You want to be able to type in NVIDIA and load up a couple of indicators that you want to see, put your MACD on, and then, MACD is a lower indicator, maybe an RSI, maybe, whatever, put those things on there and be able to, in one view, understand the trend, momentum, volume, and volatility from that stock, right? That was another thing that we did when we rebuilt Schwab's charts. I'm kind of proud to say that Yahoo actually stole this, but we broke the indicators out. Previous big charts started this. They said indicators are either separated out as upper indicators or lower indicators. And that doesn't tell you anything. And I'll credit John Bollinger. I learned all this from him. Is really, people should understand what goes into the indicators. They should understand as much of the calculation as possible, right? What the inputs are, and what it's giving, what information it's giving you, right? And then separate those out into different sort of, I'm using the term factors very loosely, but into the different factors of technical analysis. So is it trend? Is it momentum based? Is it volume, volatility? You can come up with others as well, but right, where does it fit? And if you put a bunch of indicators on a chart and it turns out that they're all trend indicators, well, you really have one indicator. And so you're not getting a full picture. So go put some momentum indicators on there to understand the speed and whether the trend is about to be exhausted or not. So it's things like that I really wanted to help both the end user of our products as well as the person who is building the products understand. So I ended up writing for about 3 or 4 years. So we started that in 2007, but they asked me to put it on hold after a while because it was taking away from a lot of my work. And then in 2018, our CEO came to me and she said, you used to do these brown bag lunches. I would really like it if you would just write a newsletter for the whole company. The question of the week. So Fridays I'd ask the question, and it might be, how many stocks are there in the S&P 500? And I haven't looked at the number recently, but I think the number is still 501, right? It might even be higher. But there's only 500 companies in the S&P 500. And so that's the distinction. There's 500 companies, but some companies have multiple classes of stock that may be in the S&P. It might be 505 now. I can't remember. I have not looked in a long time. But that was effectively the answer. And so it became just a really fun thing to write. So teaching people about vampires, right, became a way of telling them, why are vampires so rich? It's simple. They've been investing for hundreds of years. And so they've had time to let their money compound. Assuming that Vlad the Impaler, the first vampire, he was a prince. Let's just put a number on that, $10,000 in today's money. What does $10,000 grow to over 500 years? It grows to trillions of dollars. And then if you spend 1% of that every year, how much money are vampires spending today? Vampires are spending billions of dollars. Vampires are probably supporting our economy.
They've got to be the richest people in the world. It like puts
richest people in the world are
Elon,
vampires.
Yeah, it puts Elon Musk to shame. I mean, really. So
maybe Elon's a vampire. Right?
Yeah, you never know. I mean, a little similar. I don't know. Well, that's wild. Well, so you have this creative side to you that's driven that. And then how did you get was it just a natural progression for you to do what you're doing now? Or maybe you should tell us a little bit about what you're doing now.
Yeah, so let's get to what I'm doing now, because that's important, and I know that they'll be watching this and they'll kill me if I don't talk about what I'm doing now, because
for sure.
I also really like it. I'm having a lot of fun. So you go through ups and downs in your career, and there were times when I absolutely loved trading and absolutely hated, and that might be the same day I might love and hate trading. In
Mm.
fintech, it was I might love a year and hate the next year, and love the next year after that. It was project to project. And here, right now, what we're doing. So I work for. I'm currently the managing editor of the Street Pro, and so you are probably familiar with the Street. Jim Cramer founded it back in, I don't know, 1997 or 1998. It was really the first and best of its type, where you could come and get financial news and information. And then not long after they started the Street, they created something called Real Money, where they brought in people like Llanes and Doug Cass, and they would create something that was more of a subscription product, but more of a newsletter product, where Helene would write Top Stocks is what it became, and Helene would write her brand of market sentiment analysis, and it was really great.
Mm.
Um, and Jim Cramer left about 2 years ago, and I've never met Cramer. I've heard him speak before, but I don't know Cramer, don't know a lot about him. But I'll say, this is a business that was 25 years old, or is 25 years old now,
Mm.
and it's going through a lot of change. So
Mhm.
we're trying to figure out what will it look like in the future. And one of the big things, I love this, I quote it all the time, but Barry Ritholtz, who was I believe he was a Street contributor at one point. Barry Ritholtz, who's gone on to become a Bloomberg contributor and have his own money management firm. But earlier in his career, I'd say he made his name at the Street, as did a lot of people. And so he calls the Street the Motown of finance. And he says that
Oh,
the Jim Cramer
that's
was sort of
beautiful.
this, I think the name is Barry Gordy character, who, sort of larger than life in many ways. And he brought people in and he made them stars, right?
Mhm.
And so we did the same thing, or he did that at the Street. And so we're in the process now of trying to do that again. We have
Mm.
great contributors. They're all wonderful, and they provide really great perspectives on the market, and sometimes they disagree and sometimes they agree. I asked a few of them to write about GameStop recently, and it was really great to see the kinds of things that I got. But we want to get back, and we want to make we want to make our contributors, who are such great analysts, stars again, right? So we're trying to change a lot of things that we do in the business. In the past, it was really Jim Cramer. The last 5 years, I'd say Jim Cramer became our number one star. I want Helene and Doug and Sarge and Rev Shark, and I could go through the whole list. Chris Versace, I want them all to be stars too, and they want to be
Mm.
stars, and they are, because they're so good.
Mm.
So we're working at how we can do that, how we can elevate the content, not just to make the contributors stars, but really to showcase how good they are as we go and help more investors to be self-directed investors, be more successful in their trading and investing. And I say we have two different types of products, really. Our value add, if you are a trader, a self-directed trader, you might spend your time on Doug Cass's community, right? So Doug has his daily diary. Doug's a hedge fund manager. He's out there from 3 o'clock in the morning. He's sending us stuff. It's crazy. The editors have to be there editing and putting it up they start at 5:30. So the editors are in there at 5:30 in the morning, putting
Nice.
Doug's ideas up all the way through the end of the trading day. And then in the lower half of that page is a community where we have many, many people from the community, some of which I won't say any of their names, but some of which are fairly big names in finance and investing. We know who they are on the site. They really, the community ends up feeding on itself and providing great ideas just among each other. There's one guy who talks a lot about cryptocurrencies. We don't have a lot of cryptocurrency content on the site. We're going to be adding some, but this
Mm.
one person alone actually provides some of the best crypto content I've ever written, and he's
Mm.
paying us right now,
Wow.
at least for now. And so the other products that we have where you can get trading ideas or investing ideas. We have some people who are a little bit more technical focused, some who are more fundamental focused. We have one person who does really well providing dividend ideas. Another person is really great at more fundamental value-based ideas. But then we have a whole portfolio. You can
Mm.
come to us, and we have Chris Versace runs our pro portfolio, where we help investors understand not only how to put together a portfolio, and they can just copy this entire portfolio, but the thing I love about it most, every week, Chris writes a weekly update talking about what he sees in the market, what's coming up, economic things that are happening. But then he goes through all 30 holdings. He tells you the investment thesis. You know, I'm big on the investment thesis, Lewis, right?
Oh yeah.
Um, you should have a thesis. You should know why you're investing something, and you should update it frequently, right? Chris updates the investment thesis every week, and then he tells you what his target price is and his panic point, his stop, right? Where he's going to realize that his thesis is incorrect and he's going to reevaluate, probably sell the position. And then he just goes through and gives you sort of a weekly update and says, yeah, here's what happened in NVIDIA. Jensen Huang was out doing whatever he did. He spoke to these people. And so that's what we're doing. And the product is great. And we're, really excited now. We have a lot of energy around what we're doing and how we're rebuilding, building. I keep saying rebuilding, like really we're taking what we had, which was a solid product, and we're just building off of it. We have later this month, this will be the first time I've kind of mentioned this. Our marketing team doesn't even know, but later this month we're doing a roundup, or we're actually calling it the quarterly call. So this will be the end of every quarter now. We're going to have 4 of our contributors come on and really just talk about what they see in the market and have kind of a little panel discussion. And so that'll be really exciting. But it's things like that we want to do.
Yeah, it's good to hear the actual real-time discussion, because you get more color about it. But I love what you said about the Motown or the who was it who said it? Barry Ritholtz?
Barry Ritholtz.
Yeah, said that. I mean, I thought I had so many like visions in my head because I'm a musician too, and I'm thinking about Motown. I fell in love with Motown as a young kid. My parents listened to it, and the first thing that I thought about was that a lot of these people that were involved in the Motown, they were completely isolated from the music industry. So you can find a lot of talent outside of people that are like right in the mainstream of the music and of the Wall Street kind of normative Wall Street. I mean, you have to do something different really to be unique like that. And sometimes I think groupthink hurts Wall Street. In fact, I was just telling my wife this morning, I got out of the shower and I said, you know what? In a way, Wall Street is kind of like not even a thing anymore. Like, it's like, I don't even think of Wall Street anymore as Wall Street. I mean, last time I was there, it didn't even seem like Wall Street to me. I mean, it's still a thing mentally, but it's not, it's like, I really think it's time for Motown. I think you guys are right in the thick of what we should be doing because there's so many great thinkers that I run into who are not anywhere near the center of Wall Street, quote unquote. So that's great.
Yeah, and one of the things I really want to steal comes from Chicago. So Morningstar, in their quant reports, so if you have a Schwab account or any of these, they pretty much all have Morningstar's reports. These aren't the quant reports, I'm sorry. It's actually the ones that are handwritten by analysts. But on page, I don't know, 2 or 3, they have a module that says bulls say and bears say. And they go through the bullish case of a stock and the bearish case of a stock. And that's something that I want to institute everywhere. Everybody should be with everything, right? You talk politics. You should have what are the positives? What are the negatives? Whoever your candidate is, doesn't matter. They have positives, they have negatives.
That's right.
Your friends have positives, negatives. Everything has a positive and a negative, and you have to look at both sides of the story. Especially, they say you shouldn't marry your investments, right? Know what the downsides are. Know what the risks are with everything you do.
Wow. Well, there's a lot there that we can go into.
I know.
But yeah, as far as the not politics, believe me. I mean more about
we're staying away from politics.
Yeah, we're staying away from that. It's more like the I keep thinking of the narrative versus the numbers debate. I always say that I'm more interested in the numbers than the narrative. Like I start with the numbers and then go for the narrative. And I think the older I get and the more I've seen, the more I realize that it's not the narrative necessarily. It's just understanding as much as you possibly can about what is true. It's hard to do. And so much of investing is qualitative. I mean, my background, I do a lot of quant factor stuff and all that. And that's really helpful in kind of keeping you honest. But at the end of the day, when I look at the stocks that have done really, really well for me, or macro trades like futures type oriented trades, it's been because I had some piece of knowledge and understanding about something that I just knew with a high conviction that was true. Right. And I stayed with it and it made a lot of money. So that is really hard. I don't think the quant sometimes leads you there, but it may not necessarily, it's not usually the end, like the end all be all. And a lot of times, if you look at the best quantitative stuff, it tends to
Mhm.
turn over a ton, right? It's like momentum. Well, you could say like, okay, I'm going to run momentum screens on stocks, and the best parameter set is going to be me like turning over quite a bit. But then after tax, in reality, in the real world, you're really not making that as much as you would think. Whereas you might find something that's gaining momentum that no one's talking about. Like I bought, not to talk about, I shouldn't talk about specific names right now, but there's a particular stock that I bought where I understood what was happening. It did come up in a momentum screen. It was a very small company at the time, and then it just went ballistic. Now, did I know it was going to go ballistic? No, not to that degree. I didn't think it was going to go up, 500% in 3 months. But it's one of those things where if you know something, there's so much more to the narrative. So you go into the Motown aspect of things, there's value in that. We numbers are becoming a commodity almost, right? Everybody can get all these numbers, and we can move things around. Anybody can go on Chat GPT and pull, get certain things. So I don't know. I'm becoming more of a qualitative guy the older I get. That's weird, right?
Well, I have a theory on that. Let me know what you think. But I think that you are able to become a qualitative guy now because you have been a quantitative guy for so long. And so because everything that you do, there's a famous saying, it comes from consulting, I think, you can't manage what you can't measure. And so
Mhm.
everything that you've done as a quantitative person has been to measure. Even when you run that quant screen and you get a list of stocks and you know that this list of stocks is going to turn over, at the same time, you probably know, well, this is going to turn over, but let's pick on NVIDIA. NVIDIA's on the list right now. And because of these other things that I know through my experience, NVIDIA may come off in 2 weeks, but it's probably going to come back on in a month. I should
Right.
just hold it, right? Yeah, and so I think that you've spent so much time in the markets, and it comes down to the word is experience, right?
Yeah,
And
it really does.
it's why you hire a financial advisor, or you take a subscription to the Street Pro, or you want to get the experience of other people, especially as you're learning. Um,
Yeah.
yeah, so yeah,
So now,
and you can be. I was just
go
gonna say,
ahead.
well, like one thing is you can be sort of a core satellite where you can take your core investing, and maybe you want to be self-directed and buy a portfolio of ETFs, or you want to give that money to your financial advisor, give it to you, Lewis, right? And then with sort of the satellite funds, right, play money or whatever, you use your own experience. Maybe it's in your own industry or whatever it is. You're trying to add that extra bit of alpha, right? And have fun, maybe,
Yeah.
but keep yourself intellectually engaged. You have sort of the core of your portfolio over here, and then kind of the rest of it, where you can do things with as well.
Yeah, I totally agree with that. So, this is just kind of getting me into the fear and greed concept. You got involved with the fear and greed. I'd like to hear the story about how you got involved and
Mhm.
what you did in that. But when I think about the fear and greed index, I always think about that fish that's in the bowl and doesn't realize that he's in water. But if he steps outside and looks at, he's like, wow, I'm in water, right? That's kind of what sentiment is to me. It's like we're part of the sentiment. Like we're the observer. It's like the Heisenberg principle. Like what we look at,
Mhm.
we change, right? And that's sentiment. And the fear and greed is kind of like a great overall, easy to understand way of looking at that. But I guess let's start off with your story. Like, how did you get into the fear and greed project, and what was your progression through that?
So, yeah, I mean, after coming from Wall Street, I'll tell a really quick story, because I think it's in the article that I wrote too. But this story is a story from business school, and I can't remember if the numbers are correct, but they're approximately correct, and the timing is approximately correct. I was in business school part time at night. I was working as a market maker during the day, and then at night I was at NYU taking a class, and this class was a valuation class, and they asked us, we had to do a discounted cash flow analysis of a stock. And each group got to select whatever stock they wanted. And I proposed to my group, let's pick JDS Uniphase because it was the NVIDIA of its day.
Oh yeah.
Hopefully NVIDIA will have a better future than JDSU did. But
Yes.
my group was they said, absolutely, let's do that one. and the stock was trading at, I don't remember exactly, but probably about $165. Okay. And so we sit down, we do our analysis, and we're doing a discounted cash flow analysis. And one of the big inputs to DCF is understanding the growth metrics, right? And forecasting growth. And forecasting growth means looking back historically, figuring out how fast the company has been growing, and just saying, is it going to speed up or is it going to slow down? Eventually, they all slow down. It will slow down. But you have to figure out how long that's going to take. So we did the analysis and we figured out it would slow down, I don't know, over 10 years or something. Something pretty reasonable, probably pretty generous as well. And we came up with a value, again, remember the stock's trading at $165. We came up with a value of $2.25. And we looked at it and we said, can't be. We learned in our last class the market's efficient. This is all wrong.
Yeah.
I don't know. We did something wrong. And so we went back and this time we went crazy. We're like, this stock's going to speed up its growth. It's going to, instead of growing at 50% per year like it has been, it's going to grow at 100% forever. And we came up with a value of $225, right? And so the stock gets added to the S&P, or maybe it was when they confirmed that it would be, and the stock jumps to $225, okay? Jumps to 235, I think was the high. I sell my stock at like 225, all right? And so we were right.
That was a good
right?
trade.
Good trade. And then we go and we present our research to our professor. And this is where it's really funny. The professor, who was so outrageously smart, could do any math problem in his head. But he's looking at us, he's laughing at us. He's like, really, you think this thing is worth 224? We're like, yeah, here's the research, here's what we did. And he's just laughing at us. And then he says, how could this company possibly be worth more than Apple? And Apple at the time was trading at $19, which split adjusted is probably something like negative 10 cents. And he said, Apple has $16 in cash on its books and whatever. He's like, Apple is definitely worth more than JDS Uniphase. And of course, this guy's probably retired on a private island somewhere. But what I took away from this whole story, and the other thing is, we were right on both sides, right? We were right with $225 call because the stock traded to $235, and within 2 years, the stock was trading at something like $2, right? So we were right on both ends. And so what I took from that was, I'm not a great analyst, and I'm not a great forecaster. I'm especially not a good forecaster, okay? But what I can do is I can look at data, and I can back into things, and I can understand, well, if I calculate, if I back into how do I get to $165 or $200 per JDS Uniphase, I look and I say, well, the market has really high expectations of this company. And those expectations are nothing but sentiment, right?
You know what, though,
Nobody
Jason?
knows.
I think that's all you need, though, Jason.
Yeah.
I actually don't think you need to be a great forecaster. Like, that's really all you need. So, because if you know those extremes, you avoid mistakes. Because the more I do this, the more I realize that's what it's about. If you're going to put X number of units in risk units, if you will, in your portfolio, if you don't make a lot of mistakes and you compound reasonably, you're going to do great. It's just like reading, Warren Buffett always talks about read chapter 8 and chapter 20 of The Intelligent Investor, which everyone should do, by the way. In fact, I send that book to clients and just say, read this.
Great.
That's what all it is about. I mean, that's basically what it's about, what you just talked about right there. You don't really need to be a great forecaster. You just need to avoid a lot of mistakes and have a reasonable amount of diversification, not too much. And I mean, you hear about people that have made like great calls consistently, and then the more you learn about them, more you realize that there was something else part of the story. You know what I'm saying? There was another part of the story that you didn't really hear about, and a lot of it boils down to not avoiding mistakes, having discipline, risk management, things like that. But anyway, I got you off your topic.
It's all risk. No. It's important to cut me off too, because I can talk about certain things for too long. But I'll just cut right to your question, which was fear and greed.
Yeah.
And so how did I get to that? Literally, from that point in about 2000, I got much more interested in technical analysis, and I started thinking, I'm not so much like a stock picker, and I'm not so much into the MACD and the RSI. I'm much more quantitative. That's my interest in technicals. Technicals really helped me become more quantitative and more interested in looking at the big picture. understanding how to measure the big picture. And so I started looking at indicators and things that people like Ned Davis was doing, right?
Mm.
I a big fan of Ned Davis's work. There's some other providers who are like that. Sentiment Traders, another one. I like all those. I like what they do, and I started trying to replicate. You don't know what their secret sauce is, although actually Ned Davis has a really good book. I'm looking at my bookshelf somewhere out there. When Ned Davis's book is Being Right or Making Money, but then his chief strategist wrote another book where they actually go in and they tell you how to build their one of their sentiment indicators that has nine components to it. I was messing around with that, trying to understand these indicators and understand the signals that they gave. And I hadn't, around that same time, CNN was one of our clients at what was then Wall Street On Demand.
Mm.
And our CEO was out talking to them, and he was talking to Lex Harris, who was their editor in chief. And Lex said, I don't know what this is, but I want to build something called the Fear and Greed Index. Can you help me? And Jim, our CEO, came back and came to my team and he said, so CNN has this kind of crazy idea. They want to build something called the Fear and Greed Index. What do you think? And everyone on the team pushed away from the table. They're like, what a bad idea. And I was left sitting there going,
they thought it was a bad idea?
Yeah, they just, they didn't get it. It wasn't what they do.
I thought you were going to say mic drop.
Perspectives.
I literally thought you were going to say mic drop. Everybody said, that's a great idea. Let's jump on it. That surprises me.
They looked at it. Yeah, they were like, well, and they didn't know how to do it, right? It wasn't what they were interested in. The team all had very different kinds of backgrounds. And I was the only one that had that more market related background. The others were really more analysts.
Yes.
Smart guys, great guys.
Oh yeah.
But much more like they could probably pick a stock better than I can, but they cannot tell you if we're in a bull market or a bear market. So I'm sitting there saying, this is the greatest opportunity ever. And so they got me on the phone with CNN, with Lex, a day or two later, and we just started putting together ideas. And Lex basically said, look, I don't know what this thing is. You kind of know what I want to do. I just want something that really represents that quote that Warren Buffett says, which is, you should be fearful when others are greedy and greedy when others are fearful. So what is that? What does that look like? And so I just went and built it. Luckily, they gave me, Jim, our CEO's son, was also a statistics major at Yale. And so for his summer internship that year, he sat with me and we went through and took all the indicators that I had put together and we did a principal component analysis, which is really important because you want to make sure, just like we said earlier, when you're looking at a stock chart, you want to make sure that your indicators aren't all trend indicators or all momentum indicators. But the same thing, we wanted to make sure that each of the indicators within fear and greed didn't step on one another, right? That they weren't saying the same thing, or really just that they worked well together, that they were each complementary, right? There were a couple indicators that I wanted to include that just didn't make it for budget reasons. CNN is a media company. Media companies don't have huge budgets these days, so I couldn't do things like market valuation, S&P 500 valuation, or we wanted to use because by this point market had bought us, and so I wanted to use the credit default swap index, and I could only get end of day CDS data, not intraday, and so it just didn't fit with what we were doing. So there were some indicators that we left out that really would have been perfect, and later on I got to use for other purposes, but not for the fear and greed index. But yeah, right now, the fear and greed index, the 7 indicators that are there, we selected one that is purely just the S&P 500, right? Normalized so we understand if it's sort of fearful or greedy. But then we have 2 that are breadth indicators. So how broad is the advance or decline? And is that moving in concert with the market or against the market? Then we have 2 that are options related, the put call ratio and the VIX. And then we have 2 that are bond market related. One that compares the spread in yields between low quality junk bonds and high quality investment grade bonds. As that spread is tightening, you see that investors are, they're seeking out risk because they think that they can get better returns. And then the last one is where we compare the returns on stocks to the return on bonds over a 20-day rolling period, total return as well. So For all these underlying indicators, we're using ETFs. So this is actually something that can be replicated by anybody. But there are a lot of mechanics and calculations that go into it on the back end, which make it, if you are going to calculate it yourself, you got to be pretty sophisticated and have a pretty decent data feed.
Yeah.
So
well, I love that. That was put in a scale that made sense and a categorization that made sense. It almost kind of makes sense. The way that you did it is like extreme fear, neutral greed, extreme greed. These are things that we can understand. And this is, I think, one of your biggest talents, actually. Like you had said, we did principal component analysis, but we were looking for things that worked well together and complementary. As a quant geek, I would have just said non-correlated, or not. I would have used like big long names there's some statistical names that are, to describe that are like really long and stupid sounding, like to make no sense. I love the fact that you like that that is a great skill. And I think to be able to take something that is complicated and make it accessible was one of the biggest, I guess, wins from this. And it helps people understand themselves, in my opinion. Like if somebody goes and they looks at this and they say, okay, right now I'm looking at the website, it says I'm on CNN.com, markets, fear and greed. It says it's got a number 48 and it says we're neutral, but kind of tilting towards fear. So tell me a little bit about like how you would interpret this. I'm an investor right now. Let's say I have a reasonably good sized portfolio. I want to grow my wealth, but I also want to manage my risk. What would I use this for? How would I think about this for like really like practically? How would I use this?
Okay, so what does neutral mean? And neutral is really that center zone of I don't know what it is, right? So the first thing I'll ask you to do, and I know users or people who are watching or listening can't see this, but in the upper right corner, you can see where it says overview and timeline. So the first thing I want you to do, Lewis, is click on timeline, okay? And what you'll see is a chart of the fear and greed index for the last 2 years. And especially when we are in this neutral area and we don't really know what the overarching sentiment is, it's important to look back over historically, just like we said with the PE ratio, right? You can look back and compare to peers, or you can say, how is it versus history? And so what we see is this 48 is an increase over where it has been. But more importantly, we're sort of in this weird consolidation period. Fear and greed is kind of ticking up and down, up and down. It's not really doing much of anything. So, however, we have dropped from a level of greed, right? Back before April. And I'm going to pat myself on the back. I don't write much about fear and greed. I'm going to start, but I don't write much about fear and greed on our site. I did post in one of our little communities. I said, look, hey, just so you guys know, you don't really know me, but I built the fear and greed index, and here's what I've been watching. Fear and greed is just broken down. I think the market's going to break down with it. And my timing was amazing. And the next day that the market broke down. So yeah, good for me.
All
right. Blind squirrel. But so what I like to do is I like to look for patterns and try to understand what is it doing and how does it compare to the market. So a few things. All right. What really matters is fear tends to be good. What happens when the indicator goes into fear or extreme fear? What we see is that standard deviation of returns, so the volatility of the market, increases. And I think we're talking about forward volatility too, not like a month out, but days out. If you want to measure it each day and sort of see what's happening, volatility is just high when we are in extreme fear because investors are nervous. What happens when investors are nervous? Good time to buy, right? The other thing is greed happens a lot. Okay, and greed is not necessarily a bad thing. Extreme greed is oftentimes a good thing. Okay, extreme greed tends to have, there's 2 times that extreme greed happens, and one time is a great time, and the other time is high risk time. Okay, the great time is when we have been at extreme fear, the market has fallen, maybe the market fell by 10% or something, and we're starting to see a rebound. And what you'll see oftentimes is the components of the fear and greed index spike, and everything spikes, everything jumps up, and we get to extreme greed because we've gone from a low level, and all of a sudden investors are committing new capital to the money, investors are getting excited, and we see extreme greed. Extreme greed is almost always good, except when, if we were in some kind of an uptrend, okay, we're in an established uptrend, something good happens, the market kind of spikes. It's rare that we really see extreme greed during an uptrend, but let's say it happens. Well, that tends to be a period where I probably just don't want to commit new capital right now. I probably want to take a breather, wait, because risk is higher. It's extreme fear to extreme greed, but really it's low risk to high risk. But sometimes, sometimes that greed can be really good too.
Yeah.
The other thing,
Go
yeah,
ahead.
go ahead. Sorry.
No. I was just going to say that reminds me of like the traditional technical interpretation of momentum is after you've had
Yeah,
a bear market, you always get to an overbought situation. That doesn't mean the trend's over. It just means the trend's beginning. And it's almost the same concept, it seems like to me, to some degree. Like you're looking for the extremes, but sometimes you have to interpret it the opposite way after a certain condition, after a bear market, or after you've had really a lot of fear, and then it pops back up to greed. Well, that doesn't mean the trend's over. That means we're just starting to go up again. And you can have a
exactly. Yeah,
continuation of the trend. Yeah.
right. Yeah, yeah, completely. And so with anything, with any indicator, you have to look at it in context,
Mm-hmm.
right? Everything from, in economic indicators, CPI, et cetera, everything has to be looked at within context.
Mm-hmm.
And with that, I think you have to look at the context within the fear and greed index. And that's why there are the 7 components. And I actually feel that the 7 components are more valuable than that headline number, than the speed dial, right? So we
Mm-hmm.
start with, and CNN came up with these names, and I love it that they did that because they are so much better at explaining things than I am. And they said, well, here's who our user base is. We want this to be something that is a sophisticated trader can use it. And as as we heard Katie Stockton tell us several years ago, lots of hedge funds use the fear and greed index, right? They use it as one of their marks to understand what investors are doing, right? But they want it to be understandable by retail investors, by my dad, right? And so they came up with names like market momentum. What is market momentum? We're looking at the S&P 500 versus its 125-day moving average, just to see how far, like what is the momentum, right? You use that word, and it's completely accurate. What is the momentum? Is it so high that it's potentially exhaustive? And right now it's so high that it's potentially exhaustive, right? When we normalize it both over the last 6 months, but then we also go back and we normalize it again over 2 years to say, is that 6-month number, that high or low that we have, how does that compare where we've really been over a longer period of time? Then we look at, as I mentioned, 2 measures of stock price strength and stock price breadth. So market breadth. We're looking at both 52-week highs and lows on the New York Stock Exchange, and then the McClellan Volume Summation Index. So really, is money flowing into stocks going up or money flowing into stocks going down? And what we see is both of those numbers are sitting at extreme fear because
Those are great
it's kind of,
indicators.
they're
Those are
such great indicators.
Yeah, I mean, I
Yep.
remember
Yeah.
back in the day doing a ton of back testing, and those were some of the most robust indicators, all 3 of them. For especially on the new highs, it's actually new lows is actually more valuable in my opinion, based on the research I
Yeah.
had done years ago, than the new highs. But just because it showed that extreme capitulation. But those are great, and they are complementary. One is like the number of stocks hitting highs or lows, and then the other one is more the McClellan summation is also very valuable, and it can be manipulated in so many different ways.
Mm-hmm.
And I love that you have 3 dimensions to that. And while you were telling me about this, what struck me is that I always try to put things in perspective for the individual investor and for the how they can think about these things and make it useful for them. And I think one of the things that could be useful with this, or is useful for this, is understanding how you're feeling. Like, if you've just gone through a period of angst with your portfolio, and then you notice that this thing is at fear, right? Well, everybody's being fearful, and like, it's like, what are you going to do in your portfolio during that period of time?
Exactly.
how are
Yeah.
just, how you're feeling, like if you can step away like that fish in the fishbowl in the water, and say, yeah, I'm in the water, and, and this is what's happening. And what am I going to do, and stay level headed. I always talk about like staying level headed is the most important thing as an investor. It's like, if I'm overly optimistic, I need to bring myself down. And if I'm overly
Hmm.
pessimistic, I need to bring myself up. Tom Basso mentioned that to me years ago, who was one of the market wizards,
Right.
um, talking about doing that. And I've really, that's been probably one of the most helpful things for me personally, and for advising clients as well, and managing money. Just it sounds so simple. It's like, oh yeah, I know that. But yeah, but do you do it?
Exactly. And that's where it's important to have something that's quantitative and
Mm,
unbiased, right? And
yeah.
I'll tell you a story about that that confirms what you just said. But when we first, a few years after we launched Fear and Greed, I was talking with a financial advisor, and he said, "Oh, I use this thing all the time with my clients and I love it." I said, "How do you use it?" And he said, "Well, I introduced them all to it. And then when they call me, when the market is down, wanting to sell their positions, right? Wanting to reduce risk. The market's already fallen by 10 or 20%. And now they want to reduce risk. He says, okay, hang on a sec. Go to CNN Markets Fear and Greed. What do you see? And they say extreme fear. And and he says, okay, what does that mean? And and the client always says, oh yeah, everybody's afraid right now. Yes. And what does that mean? That means I shouldn't panic. And hey, let me write you a check because this is a good time to invest.
There you go. There you go. So one thing I noticed that's not on here is valuation, which
Yes.
is so hard to time valuation. So this is, valuation. So if you put this in context with valuation,
Hmm.
then I think you have a powerhouse, really, because
Absolutely. Yeah.
yeah, because then you have that long-term valuation metric. Like right now, I had just updated my factor. I have like this correlation matrix of factors like quality, value, growth, technical, et cetera, volatility. And I sent our CIO that correlation matrix to show, hey, look, within the market, like finding a value right now in the market is very difficult. Like you're not being rewarded for valuation metrics at all, or low volatility, or
Yeah.
strong dividends. And you've got all the, growth is kind of being helpful. Momentum is explaining everything.
Hmm.
And most of the performance is coming out, in a small amount of stocks. So that is a context that you can add on top of this, that says, okay, well, within this current environment, like we know smaller companies have much more value longer term. So do international stocks. That can give you a mosaic. And I have to say, a mosaic is really what works in my experience as an investor. Meaning a mosaic, meaning like you've got these pieces of a puzzle and they're all kind of pointing towards something. And like not everybody is talking about it, and
Hmm.
everybody's talking about Nvidia and all of that. But I've also had conversations where people are saying, hey, all I need to do is buy Costco and Nvidia. I literally had a doctor tell me that, like a really smart person. Yeah, I'm just going to buy, I mean, these are the things I remember hearing during the dot-com bubble. And frankly, it's a little bit scary for me hearing these
Right.
things. Um,
Yeah.
and that's one of the reasons why I wanted to bring you on. Is first of all, I wanted to have you on for a long time. We just, life didn't allow that for both of us. But and I'm glad that you're on now, because this topic I think is very, very timely. The fear and greed thing.
Hmm.
Even though right now it's giving us a neutral reading, if you put this in the context of a mosaic, this is very powerful stuff. And I'm glad that that you did this kind of work, and
Yeah.
and I can see a lot of value in doing that. When you
Well,
put this to,
I'll just say one thing really quickly about, as we're looking at the indicators and what it says, why is it giving us neutral right now? Because I think that's the key. If we look at the indicators that are at different ends of the spectrum, and it used to be organized or ordered from most greedy to most fearful, we see the S&P 500, right? So that's extremely greedy. Put in call options. So investors are still buying lots of call options, right? They're not really hedging their portfolio. And when we look at the difference in stock and bond returns right now, stocks are just doing really well, right? So those are really telling you sort of what's happening. Yeah, I know the stock market's up. Okay, what else is happening? we see that the spread between junk bonds and investment grade is rising, right? So people are starting to de-risk that side of their portfolio, the bond side of their portfolio. They're and then as we were talking about, why is the S&P going up? Nvidia, right?
Right.
So of course those indicators are going to be strong, but meanwhile breadth is really weak. So we get a much clearer picture, right, of what's happening in the marketplace. So that's the thing I wanted to add, just
That's
about how to read it, right, and really understand it and dig into it.
Yeah, that's a great addition. That makes total sense. It reminds me earlier this morning I was talking to a quant analyst in Europe, and we were looking at certain factors, fundamental factors, and almost all the fundamental factors that are very robust, solid predictors of stock returns are underperforming because you always look at them on an equal weighted basis. So the equal weight factor relative to the market cap factor, that variance is at like in its massive extreme. In other words, it's the average stock is underperforming. It's another way of saying breadth, right? Like as a technician, you would say of breadth, a quant would say something differently, but it's basically the same thing, which means that most stocks are not doing so well. And then you look at, the smaller companies, a lot of these smaller companies are losing money. And so, what is that telling you? Like there's some underlying things. So and not to be, it's not a fear thing. It's really what this does is it informs you that you need to be selective, in my opinion, right now. And not to, I want to make this an evergreen piece of content, but based on what we're reading here, just the tea leaves, it just says, be careful, be selective, look for quality, be diversified.
Exactly. Yeah, exactly. It's really just a way of understanding the level of risk within the marketplace at a given time.
Yeah. So you've told me a lot about the components and risk management. We talked a little bit about risk management. Historically, on the performance of this indicator, what would be like where's its strongest points? Would it be on the picking bottoms or would it be forewarning a top?
Well, I think there's a couple of things. So I mentioned that I posted in one of our message boards back a couple of months ago that the indicator was giving us kind of a warning signal, right? And so one of the ways that I really like to look at it is I like to look for divergences. Okay, so what that means is that the S&P is going up and fear and greed is starting to decline. And in the spirit of making it this as evergreen as possible, let's go back to 2015. The market in August, I can't remember the exact numbers. Did it fall by, you may remember, 20% or something over the course of a few days? The market really just fell out of bed.
Yeah, absolutely. Yeah. I don't know what the percentage is, but it was a lot.
Well, fear and greed had been declining while the S&P was rising and rising and rising. And people were saying this indicator is broken. And I'd even get into not Twitter wars with people, but just saying, look, here's what it's saying, and here's why it's saying what it's saying. And it came down to a lot of market breadth. And the breadth was weakening at the same time that the market was going up and becoming more and more narrow. And one day, right, so the fear and greed index was setting lower highs and lower lows. It was just consistently declining, right, as the market was going up. And it was just saying more and more and more risk. And one day the market caught up with it, right? And that's what I noticed again in January, right? December, January, February, March, into early April. What I noticed is that fear and greed it stopped going up while the market was going up, and it was just saying, something has changed here, okay? And I don't feel like, I don't love the word prediction. I love measuring, right? And so what it's saying here is, from a measuring perspective, something has changed in the market, and risk is increasing. So what I was looking for then was some sort of a signal, right? The fear and greed breaking or the market breaking, right? Just to show that was happening. But at tops, what I've noticed in general is that fear and greed starts to decline as breadth narrows, as people start to maybe buy the VIX, right, or buy puts, right? Puts are what's going to influence the VIX. As bonds start to perform a little bit better than stocks, right? These are all things that are saying investors are pulling back. Maybe the S&P is still going to highs, but investors are starting to pull back, right? We're measuring what investors are doing so that we can figure out what to do with our portfolios.
Mm.
So that's at tops, that tends to be what I see. In uptrends, sure, sometimes you see the market, rip higher. The fear and greed index goes to extreme greed, and you might get a short-term decline in that too, but probably not a long-term decline. And then bottoms, it actually does a really good job. So this statistic is probably wrong because when I left my last job several years ago, all the data stayed there, as you'd imagine. It's not my data, so I left the data there with them. But what I recall, at least through probably 2018, 19, when the fear and greed index had dropped below 10, there had not been a single 1 month forward period where you didn't make money, right? So if fear and greed drops below 10, 1 month out, you're probably going to make money. Okay, it doesn't mean going forward, we could be in a major bear market and that not happen.
Right.
But even going back to like testing data that I use, we launched in 2012, but I used data back to like 2002 or 3, something like that. So I had the financial crisis in there. I think even during the financial crisis, when fear and greed dropped enough, you still got enough of a spike back in the S&P that you made money in that little trade. So again, just like an RSI, right? It's like a momentum indicator. But so the fear and greed may roll over again in a major bear market. But generally, if economic conditions and other things are healthy enough that this is going to be sort of a short-lived decline, it's probably, it has been a strong time to consider increasing risk in your portfolio. I'll put it that way.
Yeah. Well, that's helpful. I think that makes sense to me that the market bottoms could be really useful with this as well. Now, just to kind of switch gears a little bit, a while back, I mean, you've had some, real world experience with the microstructures in the market. No, you have not been trading on the floor for a long time or been a trader for a long time, but there was some things that you kind of evergreen things that you learned there. And in particular with volume and kind of the listening to the crowd. I mean, we kind of worked a little bit on some volume stuff a little bit. And I remember that you had some very useful insights into the microstructure of volume. And so if you were, what are some of the things you've gleaned from volume itself? That just basic things that you've gleaned.
Yeah, some basic things. So everyone talks about the NVIDIAs of the world or the stocks that are getting all the press, right? And I've looked at this 2 different ways. One was, as you mentioned, Lewis, you and I did a lot of work on this together, and you were, 100% a partner on this, and you did all the really hard work of back testing. I showed up with some ideas and some words, and but this came from 2 different places. So one was that where we analyzed a volume algorithm that I had developed, which really just says, relative to, we just normalize volume just to understand, for a particular stock, I want to put all stocks on sort of the same footing. So a company that doesn't get a lot of volume, if it sort of spikes in volume, how do I see that through, the NVIDIAs of the world and the mega cap stocks that get all the attention, all the volume? When do I know that some smaller stock is getting attention, right? So how do I measure those spikes? And what I did is I just said, let's just compare them both to their own history and to their history relative to the market. So it's sort of a complex calculation. I won't get into it too much here, but what I learned from that was that the stocks that were actually getting the most attention had, they still might be good bets, but they probably weren't as good a bet as the stocks that were being completely ignored. Okay?
That is so counterintuitive.
It's so counterintuitive.
I when I mentioned that to a technician who works for a very large firm that's on CNBC all the time, he didn't believe it.
Yeah.
So sometimes
people don't get it.
Yeah, sometimes what you think is true is not true when you look at the data. So anyway, go ahead.
Yeah.
Keep going.
Well, and I'll tell you another anecdote that's kind of that proves it also. We did the same thing. So we were looking at working with the New York Times. And so I had quarters worth of data of the New York Times. And what I did is I said, let's just figure out mentions, right? Which stocks were mentioned, which stocks had articles written about them in the Times. And we did this on a quarterly basis. and we went back over, I can't remember how many years, and the data wasn't super great, but it was good enough because it agrees with what I just told you with this volume algorithm. So that's why I sort of like it. Is we created an index, and what we found was that the stocks that were having fewer mentions, what was going to happen is they were going to have more mentions in the future, right? Relatively more mentions, and they were going to get relatively better performance because of that. And maybe, and I haven't done the research to figure it out, but at least with the volume data, stocks announce earnings how often? Every
Mm,
quarter, right?
yeah.
So 1 month out of every three is going to be a high volume, relatively high volume month. 2 months have the potential to be relatively low volume. And the market tends to have an upward drift over time because corporate earnings tend to grow over time. So therefore, we can kind of assume that maybe the reason why this algorithm works like this is just that companies are quiet now. They're in a period where they're not announcing news, and maybe that month when so we're just picking stocks that are going to announce interesting news next month. But there could be lots of other things that are happening there,
That's a
and
really
it
good
does seem
point.
to be interesting at bottoms.
Yeah, that's a really
Yeah.
good point because we have the upward bias of equities, or at least we have in the United States historically, uh, for
Hmm.
a long time, and that makes a whole
Yeah.
lot of sense. Just that it would that would be the case, but things tend to pause when you have a lot of activity afterwards, one way or the other. Whether it's a lot of activity to the downside, whatever that
Hmm.
primary trend was, or that trend beforehand, you get this kind of this spike of emotion, and then that might reverse, or at least pause.
Yeah.
Which and then so and after we had done that work, I remember calling you up and saying, you know, I really like buying things when it's quiet. It's just so much
Yeah.
you have time to get in, and you're not emotionally driven, and you've done your homework,
Hmm.
and and this work not only applies to stocks, it also applies to other things, commodities. I mean, most recently, when gold was really, really quiet, that was part of my, it's like, wow, it's time to start like adding to gold. No one's talking about it. People are kind of
Yeah.
disillusioned with gold. And right now I think emerging markets are kind of in that category. Small caps are kind of in that category. Some
Hmm.
of the Europe is, European stocks are in that category, and they also have the valuations behind them too. They don't
Right.
have the sexiness of the growth of AI and all of that. So it's a great forward-looking thing, and I thought that work that you did in your concept was valuable and useful for people who are following the markets more closely. And also, if you could use it long term too, like longer term. Hey, maybe buy gold because it is so quiet. Maybe you have a set,
Exactly.
so you have a setup based on fundamentals, and then that is a confirmation from the investor psychology standpoint.
Hmm.
You know,
Well, and if you remember, Lewis, too, from the paper that I wrote, there were I looked at it three different ways, right? So there was today's volume, and that's when people talk about volume, they mostly look at today's volume. Um, but then I said, all right, let's aggregate it over a week and figure out what happens over a week. And I created a sector portfolio using sector spiders. That at the time, I think it still has. I have not been tracking it, um, but it tended to add some level of alpha. It even beat equal weighted, right?
hmm
We
that's right.
were
It
we were
did.
simply weighting the portfolio
Yeah.
towards the lower volume ETFs from the prior week, and underemphasizing the higher last week's higher volume ETFs. And then we did the same thing. This was where you were so helpful. Is we did the same thing with the S&P 500 constituents,
hmm
but it wasn't daily data or weekly data. We actually did a rolling 21 days, so a full month. And we just said, okay, how does the volume for this month compare to the last, I can't remember if it was 6 months or 1 year,
I'd have to go
right?
back and
And we
look
just
at it.
said,
Yeah.
yeah.
But
And so we just said, yeah, if it's quiet for the last month, that's really interesting, right? If it's really high for the last month, that's not as interesting. And it does turn out that those underperform. But and then in looking at it more recently, and this is a little bit more qualitative, but one thing I've noticed is that low normalized relative volume, so down to 75% of normal, um, we tend to get like an inflection point. The stock can go up or the stock can go down.
Yeah.
However, below that, the quietest stocks have tended to be the ones that have big rebounds, that tend to go up the most. And so that's sort of what I'm looking at right now, to try to figure out if
Mm.
that could become an interesting option strategy or something. But I think there's something there. And again, I need to do a little bit more research. The problem with this one, unlike fear and greed, is you've got thousands of stocks to analyze, and so as you know, I'm not a great programmer, so
Yeah.
that's where
And
I rely on the help of others.
yeah, and well, and then plus, the volume data itself has changed over time. So I think
Mhm.
John Bollinger mentioned something to me about that, or you did too. I actually there was quite a few changes in the volume or how to look at volume, or people that have been in the markets a long time said, hey, interpreting volume is harder now, which
Yeah,
I think
yeah,
that's true. But I think but the extremes I think are still in existence, that they or still valid
yes.
interpretations.
And when you
There's
normalize the data, then a lot of those differences go away, right? Because you're
right.
putting everybody on the same footing. So you
Yeah.
can't just compare NVIDIA to NVIDIA. You have to compare NVIDIA to NVIDIA's relationship the to the entire market. Um,
Yeah. So
yeah.
we've talked a lot about investor psychology, and I want to change gears a little bit if we can. And you've been when you first told me that you were teaching at CU, I thought, okay, he's going to do it for one semester and he's going to bail. I don't know why I thought that. That's so I shouldn't say that, I guess. I don't know. I'm not sure why, but you've been very consistent, and so you must really
Well,
like.
consistent until this year. Um,
Oh, is that
and I
right?
have not
Okay.
bailed, but I am taking a break. They actually asked me last year to come up with my own class, my own syllabus in trading and markets, which is really intimidating to do because it means coming up with 18 or 16 3-hour lectures.
Wow.
And so I was in the process of doing that, and luckily they called me last October and they said, um, we're going to hold off on that for right now. We overextended ourselves, too many classes, so we're going to hold off. And
Okay.
they've asked me if I want to come back next spring and just teach some regular classes. And I've said, hang on, my job's really busy, so I'm just holding off now. But maybe in 2 years I'll go back and do it.
Okay.
But I
Well,
love it,
regardless, you've been doing a lot of teaching, and
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 and I do
and
go and I lecture there.
and you lecture. So I guess what I wanted to know from you was what are you seeing students like? I mean, because I know when I've the little bit of teaching that I've done, I saw some changes happening with students' interest in finance in general. So
Mhm.
what are you seeing with younger people in terms of their interest in finance? What parts of finance are they interested in?
Well, one thing about I hear, I'm hugely into cars, and you hear people say, kids these days, they have no interest in cars. Kids love cars. Kids love everything that we loved when we were younger. And
Yes.
and my students are all really engaged. They really are interested. Now, I teach a lot of core classes, so that means that not every kid that comes through my finance class cares about finance at all, and they shouldn't. Right? They're interested in marketing or whatever. But the kids who are engaged, which I would assume is a similar percentage of the kids in those classes to when I was in those classes, even, versus my MBA, when I would take a core class. It was NYU, so I don't know, half the class was finance majors, but the other half of
Mm.
the class were marketing and whatever else. And they didn't care about finance. And so I would say that the percentages are probably, really similar to what they were back in 2000, using that as a guide. I was a philosophy major in undergrad, so that doesn't count. Um, but the students, get it. They're interested. A lot of them are trading. They're not trading. They're not trading Nvidia, but they are trading GameStop, and they are trading crypto, and they are trading on Robinhood, and they get that Robinhood is not a good value because Robinhood, yeah, it's free, but so is Fidelity. Robinhood, you have to pay for research. Fidelity, you don't. Um, and they get all those things, but they are really excited about it because they're driven. They want to become, they want to be financially independent. They
Mm.
want to be able to buy nice things and take trips. Um, there are a lot of other different things. They may or may not want to have kids, right? But they feel stress around buying a house, right? And they know that their career is not necessarily going to be the thing that allows them to buy a house, right? Their salary may not keep up with inflation, or it may not be enough to live in the place where they want to live. So they look for other ways, and they think about other things that they can do. They're side hustles, right? And side hustle may be doing some trading in the market. So they're also, some of them, I think it's some of the older people who are a little bit disillusioned with the markets. Some of the people who got in the GameStop era, some of them are leaving. We see that. I was on the phone with another provider recently, and they were talking about some of their active traders, people just saying, wow, this stuff is hard. But what I love about that, though, is when people say this is hard, if they liked it. So if they didn't like it, they weren't really a client anyway. They weren't, or they weren't really a self-directed investor anyway. They were going to
Yes.
leave no matter what. If they do like it and say this is hard, they're going to pivot. They're going to go away from being some kind of a short-term trader to being a self-directed investor who's really engaged in building a portfolio. Or they may even come to someone like you, Lewis, and say, I want to build a portfolio with you, but I'm going to be really engaged. We're going to talk a lot. We're going to talk every couple of weeks, and you and I are going to strategize about the market. And right, they'll be really like good customers in that way, if you see that as a good customer. Right.
Well,
but like they're engaged. Yeah.
yeah, I've noticed both. Like, there seems to be like a little bit of a cycle. Like, I'm just thinking of real clients that come in and it's like, okay, well, I have this Robinhood account and I really want to dive in, and I jumped in and I did a lot of stuff, and I may have even done, pretty well, but now I'm married and now I have a
Yeah.
child, and now I've got all these other obligations and I don't really want to spend time with it.
Uh-huh.
And then they roll that over into something else. Um, and I've also seen people where, and I encourage it to be engaged, where it's like, okay, like you said, here's your core stuff. Here's what we're going to speculate in or do some other types of strategies in. We're going to allocate a certain amount and
Hmm.
go for it.
Yeah.
And I strongly encourage that, to be engaged. Um, and so I think it just depends on the person. I'm very much for, I love the fact that you can be self-directed and that there's so many resources that are available. And what you guys are doing allows people to do that. And I don't think it's an either or. In fact, many people, I would say most people have a bit of both now. High net worth
Yeah.
investors too. They have some money where they're using advisors, wealth managers,
Hmm.
and then they have this. It's like they know something a lot about a certain industry or something like that. A certain percentage of their money is allocated a certain way, because there is a big difference between making money and keeping money, and how you manage your money is different. The strategies you use are different. You need concentration when you're making money.
Yeah.
You need, and that would be typically in your business or your profession or whatever. And that concentration is what allows you to really make money. When you get into the keeping money realm, it's about having reasonable diversification and having being able to be bulletproof, right? Not only from an investment standpoint, but asset protection and all these other things that you need to do keep your money. So, and I'm kind of in both worlds, in my profession, but I think the speculation and being involved, even not in speculation, but just being self-directed, is a great thing. And the fact that we have individual investors that can do that now, more easy than ever, is a good thing.
Absolutely. Yeah.
Yeah. So,
Yeah.
I mean, this has been a great conversation. I mean, so what are you working on now that you'd like to share? Anything got you excited or jazzed these days?
Well, I'm just so excited to be working with our 18 contributors. Every one of them is such a professional. They work so hard. Also shout out to our editors, because they're the guys who are backing everything up. But what I'm excited about is to take all that great content that they're building and kind of steer it in a couple of different directions. So to continue everything that we're doing now, but then to add to it, right? Like I mentioned before, we're doing our markets. I keep wanting to call it a quarterly roundup. I think we're calling it a quarterly market call. And and working to put together a panel, right? A panel that's really interesting and engaging to different types of investors. So we'll have Helene Meisler, who is a great technical analyst. We'll have
Mhm.
Chris Versace, who is running a full portfolio. And then we have Peter Chur, who has a great geopolitical look at the markets and is a bond guy.
Hmm.
And then Malia Bengali, who has a really wonderful global perspective, or a global macro perspective. So just an all-star panel of people who can come and give us really great thoughts on the market and where it's going and what they see. So I'm just excited to be able to not have to write all my own content, right? Not have to build these things dynamically, and actually have humans who know what they're doing to go and work with, and just take ideas from them and have them take my ideas, and all of us just work together to build something that's better than it is now, and something that's going to be great for the next 25 years.
Mm.
The other thing that I'll throw out there is we are in the process of, like I said, we're really strategizing. We just relaunched the street. So it used to be called Real Money, is the division that I run, and so we used to call it. It used to be Real Money Pro. We collapsed all of the products into one. So now all of our subscription products are one, and that is called the Street Pro. Okay, there's the Street, which is the free side, and we are one of the top 10 business sites in the country.
Mm.
And then we are the Street Pro, and that is the subscription side, where we give you actionable research and portfolio ideas, education, etc. And so, as I said, we just relaunched about 2 months ago, and so I'm happy to offer people who are listening 3 months free right now. So
Whoa.
we
Okay.
charge, I think it's $982 is an annual subscription, or $99 a month. So this is a free 3 month subscription. I don't have a code or anything, so maybe, Lewis, the best way is if people reach out to you,
Yeah.
and then you forward them to me,
Or
or
is there a way that you can get a link to us, and then we could put it in the show notes, or is there?
I'm working. I'll tell you what. We just decided this last week, so
Okay.
I'm working on getting a code. It'll be something like subscriptions to the street, Jason. So they'll know who it is, and so I'll be able to get you that pretty soon.
Okay.
Hopefully in the next week or two. I hope that's not
That'll work. Yeah,
too
because
long.
we're about 3 weeks out right now. Yeah, so
Oh,
I've got
perfect.
3 episodes before this one. So
Great.
that would be perfect. And that's thank you for doing that. That's excellent, excellent stuff. And
Yeah, I probably should have told you that before, but
that's
yeah.
okay. That's the power of editing. We could always edit stuff out. So and we'll just make
Yeah.
it, we'll get it to sound right. But this has been great, and I'm glad you came on. And is there any if somebody wanted to reach out to you or anything like that, any way that you would what's the best way for people to look you up?
So the best way, so LinkedIn is always great.
Okay.
I like LinkedIn because then I know exactly who everybody is. And otherwise, I don't go to X or Twitter very often. I spend a lot of time on Instagram, though mostly car related, my other passion.
We didn't even touch on cars. So you know what? We have to touch on cars. I'm sorry. We're gonna need to edit this and put it back somewhere earlier. So now I know you're a huge car fan, and you joke about your racing capabilities, and that you're like maybe the slowest guy out there racing. But I have to know, could you just give me your analogy on how racing cars is like investing, and what you should glean from race, the skills needed to be a good car racer versus a good investor?
Yeah, absolutely. So as you know, I wrote an article last year it's on the street, so it's completely free, um, titled "What Car Racing Can Teach You About Investing," and it goes through the story of Sterling Moss in the 1955 Mille Miglia, which was this crazy dangerous race through the streets of Italy, banned in 1957. The movie, the Ferrari movie that came out Christmas of last year, was actually centered around the Mille Miglia, the 1957 Mille Miglia. So people who have seen the movie know how dangerous that was. But in
Mm.
1955, this guy Sterling Moss went and set the all-time record, averaged right around 100 miles an hour for almost 1,000 miles of driving country roads across Italy. You know, we live in Colorado. This would be like driving 1,000 miles up in the mountains right behind me, and averaging 100, hitting 175 miles an hour, and still able to win the award for being not only the fastest car, but also for the most efficient driver in the race. And so that kind of is the cornerstone of what investors can learn about what car racing has to teach investors about investing. Is it all came down to a couple things. Risk management, being in the right frame of mind, right, to understand what was going on, having a plan, right? That plan puts you in the right frame of mind so that when something bad happens, as it always will, right? Sterling Moss hit hay bales while he was driving. He drove off into a ditch. These things didn't fluster him because he knew what he was doing. He understood. He used technology, right? He basically had a plan and was able to set targets, goals, risk management for the entire race, so that when he finished, not only did he set the record, not only was he the most efficient driver, but he also beat the number 2 finishing car in an identical car by 30 minutes. And that guy was a 5-time world champion, right?
Wow.
So you're going to have mistakes. You're not always going to be the best or the fastest or whatever. But if you have a plan and stick to that plan, and if your plan isn't working, have other plans that you can go after, that are well thought out, right? You're not just moving from plan to plan. Have a process, right? And you will be successful in the end. That's really the big thing. That's what it comes down to.
Yeah, that's great. That's good stuff. All right,
Yeah.
Jason, thanks a lot. I appreciate you coming on.
Thanks,
And,
Lewis. It was a lot of fun.
I'll look forward to see what you have coming next.
Yeah, we'll see. We'll see. At some point, maybe I'll write this book, but
That would be
it's
good.
slow going right now.